All right, so today we're going to talk about banking, cash management, things like that. Things have changed quite a bit in banking over many years, and what's happened is things have kind of simplified. You used to have distinct institutions. You'd have savings and loan type things. You had regular retail banks. You had credit unions, and they couldn't quite get in each other's lane. Then the big brokerage firms. After deregulation, all those barriers kind of went away. So we'll talk a little bit about the different institutions, but um, really from your perspective, what you're interested in is convenience and low fees. You're interested in the utility that these banks are going to provide, how they're going to make your life easier rather than what they're actually called. There are obviously several banks now that are purely online, and that works for a lot of folks. Other people who might have reasons to deal with cash or might need a local presence, well, they might have to go with a local bank, or you might have to have a couple different banks. But anyway, we'll look at what the options are. So retail banks are something like maybe a Wells Fargo, as opposed to a credit union. But again, the difference between those things is not that big a deal. These funds, when you deposit money in there, they want to make sure that people do feel comfortable. So the federal government, this FDIC, will insure up to a quarter million. But in reality, when banks do fail, there was a bank, Silicon Valley Bank, went under a couple years back, and people had, you know, in excess of these amounts, four or 500,000, half a million in there, and they were still covered by the company, because in the larger scheme, the reputation of the overall banking system is quite important. We work on a system, well, the world works on a system of what they call fractional banking. So what happens is if everybody who has an account with a bank, if they get nervous and they go to the bank and they all demand their money, that's called a run on the bank. Well, the bank will fail. Banks, by definition, will fail because they deal with fractional reserves. They have to keep a certain amount, a certain percentage on hand. But the way banks make money is they take your money in, they pay you, let's say 3 or 4%, and then they load it out to somebody else at about 8%, and they make their money from the difference. So, they might make small amounts on fees and convenience charges and things like that, but the primary amount of money, wealth that they generate is by, using that sort of arbitrage between the different rates. And so, the fact that if consumers lose trust in that institution, it can spell ruin for that bank. If people get nervous, it's bad. So anyway, the federal government's very much incentivized to do what they can and assure these numbers. Now, again, $250,000, $250,000, isn't quite what it used to be, but it absolutely does not matter to me and most people, because if you're keeping that kind of money in a regular retail bank, you're not really, thinking this thing through. You should have that money invested in the market and real estate and something else that's going to get you a higher return than what the banks are paying you. Saving institutions, thrift institutions, yeah, they used to have specific, you know, organizations, bank, and there you'll still maybe see some legacies there. Credit unions, you know, serve members. So yeah, you do have to be a member, but that's why they'll often talk about shares, and they'll talk about membership, and that's it's more marketing than substantive differences, to tell you the truth. Now there are other companies out there, the finance companies. One of the big ones used to be HFC. It was a Household Finance Corporation. Anyway, it kind of looks like a bank, but it's not quite a bank, and their interest rates are pretty excessive. So these guys are one step above, sort of the cash for titles, or the whatever, the signature loan people, payday loans, all that kind of stuff, where they can use some creative business practices to get around the usury laws. Usury is a concept that you can only legally charge somebody a certain interest rate. Above that is considered illegal. But if you sign away your rights and it's not really a loan, it's this and that. Anyway, they're creative with it, and they can end up, charging people horrendous rates. If you notice, like credit cards, you'll notice they're typically based out of, I believe it's North Dakota. Used to always be Maryland, but anyway, certain business-friendly states and by definition, conversely, very consumer unfriendly, they have different laws, and so it, they're smart. They want the big banks to locate there, but if it comes down between a consumer and a big bank in those states, that's their niche. These states side with big banks, and so the big banks tend to locate there and give them their business. So it's a bit devious. Securities firms. So you have big brokerages, securities firms. Securities are the broader term for different investment vehicles that like stock market bonds, things like that might be contained. Well, these guys, due to the broadening of their role and their ability to overlap with banks, they can do a lot of the banking services. Insurance companies, they try to get into investment type things. They're not going to be able to do the same sort of banking rules. And the problem with insurance companies, whoops, is that they um, have to maintain incredibly high reserves because for them it's even more serious. They're insuring properties and things like that, so their requirements to basically not take much risk is statutorily, by law, much higher, and so it kind of prevents them from, maximizing investments to their full potential. And then this financial conglomerate, which is what I've been alluding to, big companies that do it all. Bank of America. Now, I'm not saying, you may not want to go with those guys. Citigroup. Sometimes you get too big, and there's some overlap. For me, and I'll discuss this a little later, but I prefer to have a bank with uh, my different income streams going into that and all the bill paying, all that stuff coming out of those accounts. So there's going to be a large volume, a lot of uh, transactions taking place. And then I prefer to have a separate institution that would, have quote unquote real money, bigger chunks of money. These banks and normal checking accounts, you're not going to get an interest rate that's even competitive. Now you're willing to give up some of that, interest for the convenience and just the necessity. You shouldn't be keeping tons of money in a checking account anyway, so the fact that you're not getting any interest or very little interest isn't a huge factor. And then investment companies, which share back to um, the brokerages and the rest of that. Okay, so bank subsidiaries, yep, they can kind of do all the same stuff. Now, securities, they can also take deposits. So things are changing all the time. Securities can also, the services can be blended to where pretty much most of these guys, with the exception of the insurance company, there can be quite a bit of overlap. I can write checks from my brokerage account. I can pay my bills from my brokerage account, and I can even get a credit card from my brokerage account. So not a huge problem. Now, if I want to set up, auto bill pay for my utilities through my brokerage account, probably not happening. But for me, if they're not going to charge me a convenience fee, I don't want anything going through my credit or through my checking account that can go on my credit card. If they're not going to charge me a convenience fee, I mean, I've got a credit card that gives me 4% back. It gives it to me in Bitcoin, but hell, that's better than cash in my mind. So 4% is significant. And anyway, but not everybody will take credit cards for like NSTAR, the gas company will not do it. The utilities, the phone company, even my mortgage, which is silly. That's a big chunk, and let me put it on a credit card. So anyway, you got to explore and see what your options are. Obviously, I'm not talking about credit cards like financing all this. I'm talking about being a convenience user, putting it on the credit card and making sure that credit card bill is zeroed out when the statement closes out so that I'm not paying interest. If I'm paying interest, that 4% is going to be eaten up in a heartbeat with the interest rates that credit cards can charge. All right. So checking accounts, yep, it's all about liquidity, draw, writing checks. Writing checks is actually, that's getting a bit anachronistic. I mean, most of the time you can do EFT transfers, you can do Venmo, you can do all kinds of stuff. So checks, I've had some foreign students, come up to me just to ask, well, why do we even do that? Why does the United States still deal with checks? My check volume, I used to go through books of those years ago. Now, I write, I don't know, two or three checks a month, maybe. Um, so it's just not as convenient as it used to be, and or the other stuff is far more convenient than it used to be. Liquidity though, is liquidity is you don't want to spend a lot of time here. You want to keep things fluid and simple and get your bills paid and liquidity, that ability to, put that cash to work, um, turning your money into cash by definition, and the high volume of transactions. What I mean there is that in a checking account, there's going to be a lot of bills coming and going. If there is some fraud or something like that, um, number one, it's not going to be huge dollars because I don't keep huge dollars in my checking account, but it's going to be contained to that one account. I think I don't know, I've certainly been there about every 6 months or so. I'll get a credit card warning or something that, hey, did you authorize these charges? And now they're simple enough. They'll actually track, the location of your phone if you give them location services, and they'll see, is the phone and the credit card in the same place? This is weird. Anyway, but if you do have identity theft, it tends to go in a flurry. And so it is scary if you have a whole bunch of money in those accounts. If it's more limited, um, and contained to a bunch of transactions, it's pretty much identity theft. Generally, it's going to be a bunch of transactions. But if they're all of low value and there's not as much money at risk, it's not quite as serious. Pardon me. There we go. Okay, so pay your bills on time. Yep, all those fees can get excessive. You know, we'll trash your credit rating eventually. You'd be surprised. We'll talk about how to check your credit score here in the next couple of weeks, and one little bad hit is generally not going to make it onto your FICO score. But what will happen is you'll get charged $35, which is bad enough, or whatever the fee they have for late payment. So one thing that works, and I mean this happens to everybody, me included, is if you do have a late bill or some sort of buffoonery on your part and you're assessed some fee, don't just suck it up. Call those people. And I'm kind of a proponent of not so much even emailing on this because, email is going to be probably read by some AI, some bot, something. I'd try and get somebody on the phone, which is a huge pain in the butt. But, they're smarter than me now. Even on the phone menu, they'll say, if you're calling in response to your, you know, whatever overcharge or your late payment, we can't consider waiving that, and you'll hear the little AI thing go off or get approval from whoever. And as long as you haven't done this, like, again, if you're doing it every month, nah, it's not going to work. But every year, once a year on an account, um, just about always they'll forgive them. I haven't had one. I do this maybe once a year, and I've never had one not go through. And so why does this happen to me? Why do I have, a late payment or not enough funds in the account or something like that? It's because I run that checking account down. Run it very tightly. I do not like to have money sitting around idle. If you've got money in a checking account, if you've got 10,000 bucks in your checking account, 20,000 bucks, you're you're not winning. You are number one, you've got that money at risk to identity thieves, and then also you got money sitting on the sidelines. It's being eroded by inflation. You need to do something with it. Even any kind of account that pays, a money market account that pays 5%, that's something. And better than that, if you don't need it for a while, then put in your general investment fund and you should be able to get better than 10% on that. So you just don't want idle cash sitting around, and you don't want, tremendous sums in your checking account. Again, you're like, well, what if something happens? Well, that's why you have some sort of emergency fund. But again, if you're going to have an emergency fund, say six, 10,000 bucks, whatever it is you deem necessary, it should not be in that checking account because number one, psychologically, you're going to see that money teasing you every month, taunting you, looking for some reason to spend it. And then also it's not really getting the interest rate. It takes when I do a electronic, I've got Fidelity and I've got my primary bank is in Texas, but it's they say, oh, it'll take 2 to 3 days for the transfer. It takes 2 to 3 hours typically. I guess they're just going with the worst case scenario, but I transferred some money the other day, and yeah, I've never had it take more than more than within a business day if you get on it early in the morning. So anyway, so all those fees, you're subject to them if you pay it. Hmm. I'm not sure where this car lease thing crept in here. I'll have to check on that. But anyway, any loans or any bills that you pay late, yeah, you're subject to the fees, and it's your fault, and you can't say much about it. So um, try not to let that happen. If it does, try to see if they can't get them waived. Okay, so checking accounts. Yep, you can get debit cards, other things linked to your account, mobile online banking, online bill pay, online account transfers, electronic deposits. Most of the time, again, people I don't think there's too many boomers in this class. I mean, you've probably known nothing other than direct deposits. Employers don't want to be handing out paychecks. And you don't want to be getting mail in your um, box. I mean, you want the money now. Typically, an electronic funds transfer, you get the money a couple days quicker than any type of check, and there's less instance of fraud and everything else. So I think you guys are fully aware of electronic funds manipulation. Banking services, yep. So monitor your balance, record checks, other debits. Again, you have to look at this kind of electronically. If you wait for a mailed statement, and most of us don't even have mailed statements, but if you wait for the download of the monthly statement, your ability to react in terms of identity theft is diminished. What happens is, as a merchant, I've taken credit cards as a merchant. Number one, I don't like to because they charge me 3%. But again, there's some psychology there too. If it looks like somebody's, you know, kind of sloppy and is going to spend more money if I give them the chance to use a credit card, then I'll take the credit card all day, knowing that they're going to not live within their means and I'll make a bigger sale. But if it's a fixed sale, yeah, the last thing I want to do is pay that 3% vendor charge. And I don't. You really get a lot of resentment as a vendor. Personally, I've found when you say, well, I'm going to have to charge you 3% more, people kind of cry foul with that. So maybe it's legitimate, but I don't think it's very smart as a vendor because it just alienates the customer. But anyway, and then you're going to look at it and reconcile your balance. But anyway, so in that process, the credit card thing, the other problem with the credit card sale is it takes me out 4 or 5 days to get the money. Well, if I sent some sort of fraud on my account, and I called the credit card company right then, they absolutely have no problem in canceling those charges right then because they haven't paid the vendor yet. So easy. They can nip this thing in the bud. If you let it go a few weeks, now they paid the vendor, they got to recoup that money, they got to get it back. If you let it go more than 30 days, now they can be snotty about it because you should have, you know, kept track of it, and outside of 30 days you start to lose or have lost your legal rights. So again, I've had situations like this where one of my daughters was down in Atlanta, Georgia one time, forgot her keys and had to take a cab just to get to the airport hotel because she had to wait for the keys for me to ship her keys down to her, and jumped in some taxi. And thankfully, the only bad thing that happened was she got ripped off. They charged her $100 to go like 3 miles or something. But it was clearly fraud. So I called the credit card company, and yeah, sure enough, it was seamless. It was refunded back onto my account. That merchant was identified, and then there was really, I mean, anyway, I found out that the merchant who the credit card was issued to, he wasn't even the cabbie, wasn't even alive. It was somebody else using his medallion. That guy had died a couple of years back. So I mean, you don't know what kind of sketchiness you're getting in on, and the same people who rip you off will, well, they could do worse. So anyway, check float used to be a thing. Float meant that when you wrote a check, there was a certain delay between when that check was cashed and when it was actually deducted from your account. So people would write, checks, or they post date checks. You'll see people do that. They'll go, well, I'm going to write this check for next week, and they'll put the date on it, and essentially they're forcing a float. If you're a vendor and you're taking that sort of check, you're kind of silly because that person is running the limits. It depends how badly you want to make that sale. But anyway, even back in the day, checks were flown around by airplane to get to where they needed to be, and so it took at least over a weekend to get it done. Now everything's done electronically, so it's almost instantaneous. It's just like a debit. Um, Credit card financing. Yep. Visa, MasterCard, and American Express. American Express is slightly different. That's how I get 4% back because American Express charges an even higher rate. I think they charge 4 point something. I would take American Express, but I'll use American Express, but not all merchants will take it. So that's the other thing. You go, oh man, I got this great card. It's American Express. I really like it. Yeah, certain vendors will not take it again. So just means you have to have a fatter wallet or a couple cards or whatever. Debit card, I think we're familiar with how those work. It's just like writing a check, comes directly out of your account. Some positives, some negatives. I prefer a traditional card, but if you have problems with credit cards, a debit card is not bad. But there is some recourse issues, like for example, you're trying to rent a car or get a hotel. If they see it's a debit card, they're like, oh yeah, no, we need a regular credit card because they know that the debit card is limited. It can only, you know, be written for the amount that's in that account. So what a rental car company or a uh, hotel wants to know is that you've got some, reserve in case there's some damage done. The other kind of beautiful thing about a credit card, I did this recently too. I had a rental car, and in brand new one, and it got smacked a little bit, just by a curb or something, and it was bad. Anyway, um, I think I paid $65 and I didn't take their silly insurance, any of that. Um, I used the what was covered on I guess it was a Visa. It was actually the Alaska Airlines Visa, and it covered it. Now you need to check your credit card before you go, making deals you can't cash, but verify you've got that coverage. But man, it was a beautiful thing. And the only reason I was eligible for it is because I declined all their goofy coverage. Their goofy coverage would have taken it, but if I would have reported it to my actual insurance company, well, then I would have been assessed a strike, an accident. Now, I think in the big global scheme that I'm not sure whether the credit card company reports into that master database, but the insurance companies, I know for a fact, have got a huge database where if you, crash a car with one company, they share all that information with the other company. So they go, oh yeah, this guy's got whatever number of accidents. Now this wasn't a moving violation. It wasn't even a moving thing. So who knows? Anyway, enough on that. But yeah, there are some protections, some perks with credit cards. All things being equal, if you can pay them off on time, I do kind of like that. Wires and EFTs. So let's say you need to move some money, you need to pay somebody, and it's big boy sums of money, 15, 20 grand. If you do a wire transfer, it's instantaneous. The funds are verified. Everybody's like super comfortable in the transaction, but it costs you 20 bucks. International wires, they used to cost 50, but anyway, there's technological workarounds for that now. There's other services, third party services that will do those transfers for, 10, 12 bucks now. So when I have to send money back and forth to Germany, I don't send a wire. I use a thing called Wise. But anyway, if you're involved in that kind of stuff, there's alternatives. And bigger picture, the smart money is going to be in crypto and everything else because that's disruptive and revolutionary and instantaneous and secured by the blockchain. So that's where things are going to end up, but not quite yet. Um, yeah, EFT, um, not an ETF, EFT. So what I'm talking about here is electronic funds transfers, like ACH debits and credits. So if you send money directly from the bank to another place, but you don't use a wire is 20 bucks. EFTs take 2, 3 days, and they're free. So depending on the speed that you need, different sorts of things, but the banks know what they have to offer. Um, Safety deposit box. I just don't see this happening. Yeah, you could imagine, you get even a place like Anchorage with whatever, a couple 300,000 people. You really think there's 300,000 safety deposit? I venture to guess there's probably less than 100 in the whole state. 1,000 maybe in the whole state. But anyway, it's kind of silly. It's good on, James Bond movies and stuff, but I think in real life, not that much of a deal. ATMs. The big deal with ATMs is we all need access to cash, especially if you have a online bank or just a life where you're not hanging around a bank during business hours. So you need access to cash, and that's how it's done. Although, man, most things now can be done um, electronically with tap and whatever that where you tap your card or whatever. I was in Ireland in the fall. In fact, I'm going back here in the spring, but oh my God, it's amazing because number one, they don't tip, which makes things very nice. Not good for the servers, but I guess they're paid in other ways. But if you walk into a pub and you want something, it's a loud and crowd place. You just, hit the button on your phone and you bang it into their little credit card reader and, they give you a thumbs up. And people who fumble around with cash anymore, you just, I was there for, I don't know, a week or so, and I just didn't see it done. You just, because you can't even talk. I mean, it's too loud and it's just so much easier. But if you're in a tipping culture, now they got to hand it back to you. You got to set the tip. And now here it was like just two guys doing like a fist bump, me with the phone and the guy with his little portable credit card thing. And you just bang them together and you're done. So things will change as we go. And there's, all sorts of other technology that will be out there. Is it a good thing? Man, it's convenient. But yeah, it is a little dangerous in terms of basically Big Brother knows everywhere you are, where your money's going, and they call that programmable money. If you ever hear people talk about currencies where they want electronic currency type things, and they'll say programmable money. That is a very dangerous term. That means they can kind of turn your money on and off. Oh, we're having a COVID restriction, so we're just turning everybody's money off for the next 24 hours. Meaning, yeah, have fun doing whatever you thought you're going to do. You can't get the money at all. So, and some places, it's very hard to spend cash. So we could be going into a different, darker world. Cashier's check, they have a place. What happens with a cashier's check is when you go to write a cashier's check, number one, you got to go to the bank, you got to pay a little fee, and um, but they take the money from your account right there and then, and they allocate that money against that cashier's check. So it's no longer a risk for somebody taking a cashier's check, as long as it's not like a forgery or something. But there's no doubt that that check is going to clear because those funds are already a lot, you know, lined up against that check. Money order. Now we're getting to things where there's a large segment of the population that, you know, they may be unhoused and they are also probably unbanked. And then there's other weird type things. Well, to get a passport, it used to require a money order. It's just really silly and archaic. It's the same people who want faxes, they also want money orders. It's an ancient system that's kind of probably going away, except for the unbanked people. And that whole business of remittances and sending money back and forth, that's just a dark world. It's very expensive for the people who can least afford it. Although, once again, crypto will be quite disruptive and probably eliminate that. Think crypto, people think crypto's, oh, that's for all these rich tech bros, but it's really the poor dude schlepping down the road in Africa that's got access to nothing. They've got currency that's inflating at 50, 60. When I was in Turkey, they would issue new bills and they just have more zeros on them. If you held money in Turkish liras, it was suicidal. The money just deflated overnight. But if those guys can put their money into Bitcoin, all of a sudden, it levels the monetary playing field worldwide. So there's actually a pretty strong humanitarian case, libertarian case for cryptocurrencies. But anyway, digress. Okay, what so when it comes to your homework for tonight, it'll be explained here at the end of the assignment or the end of the lecture, but you're basically going to go through and select around four banks that, and I'm not trying to get you to switch banks. If you're happy with your bank, that's fine. But make sure you know what you're kind of doing, that you're not doing it just out of, laziness. I never really checked and saw what the options were. Well, tonight is, or whatever, when you do this assignment, this is just kind of way to look around. Like, for example, business banking. I used to have a local business bank because I dealt with a fair amount of cash. I was running a campground and some other stuff. And finally, their fees and their policies were just absurd. It was just stupid. And there was a bank, a totally online bank. I'll mention their name. Novo was their name. Just amazing. No fees, no nothing, no hassles. And I deposited the checks mobily. Locally, they wanted me to pay an extra, I don't know, 15 or $20 per month for mobile deposit plus a per check amount. These online banks, the only way they can do it is mobile deposit, so they're not going to charge you anything. It was just, it was just such a, it made that part of business actually fun again. And, when you're trying to run a small business and everybody, all the financial institutions, they want a percent here or a percent there. Uh, anyway, it kind of kills you. So anyway, you're going to look at what your different options are. Maybe being able to walk into the bank. I mean, I've got a silly my um, Alaska USA account. I guess, well, it doesn't really matter. I give you the whole account number, but it ends in all ones. I mean, like 1111. I'm like, oh, that's a beautiful account. I'm not giving that up. Is that maybe an emotional response? Yeah, but you know, it doesn't cost me much. I think $5 a month or something. But that's just such a. And if I'm going to have a local bank, just having that easy account numbers, it's kind of nice. Anyway, like I said, when you go to Walmart, they don't necessarily have banks in there anymore. They sometimes will have branches, but I think they've done away with that. But they do have a bunch of financial services because that's kind of their clientele. If you want to do some Western Union transfer off to, somewhere else, some remittance or something like that, they can probably work that out. They'll do those money orders. They'll do things for people who have no banking, relationship or maybe don't have a proper ID. And it's a good role. Um, when I grew up, I was, working with a lot of I don't mean in a pejorative sense, but a lot of illegals. And these guys were, I mean, they got abused because uh, the checks would be written to them by the employer, but they had no ID to cash the checks. So there were convenience stores that would cash the checks for them, but they would make them spend at least half of the check within the convenience store. And so the prices, they're buying products and stuff for double, triple the price. They're having to do their grocery shopping in like some sort of 7-Eleven thing because that's the only place they can cash the check and the only way you can get cash. It was just, anyway, predatory doesn't begin to describe it. Again, crypto will be disruptive. Um, if those guys could, you know, get their money and deposit it into an account but anyway, crypto will have to evolve between now and then, but it's definitely on that way. And you're probably not going to see it as disruptive as you think it is. You're going to see, companies like Visa, MasterCard suddenly have different services that probably are running on a crypto backbone, but they won't explicitly say it. But yeah, they're going to have to. The jig is up in terms of being able to charge the rates they do and have the delays they do when things are instantaneous. So we talked about interest rates. It's based upon, they take in money and then they loan it back out and they make money on that spread. Um, there is a certain amount of risk, um, investment risk, inflation risk, default risk. So the banks will typically never have a rate of approaching zero. They will have a rate that they'll loan in between banks that will be a very low benchmark rate, but the only people that get that are other banks who have very little default risk or no default risk, essentially, and then everybody else is somewhat higher. If you have bad credit, um, you're going to be charged a higher rate because you present more risk. So that's what happens. Um, Conversely, if you want to earn a higher rate, you're going to have to give up some of that liquidity or come up with a larger sum of money. And so they have instruments called certificates of deposit where you say, okay, I'm going to keep $5,000 in there and I'm going to have it in there for a minimum of a year and they'll pay you a slightly higher rate. If you have something with no minimum and um, the ability to pull it out tomorrow, well, then that interest rate's going to be quite a bit lower. Now, if you violate that, if you say you're going to keep it in there for a year and you pull it out 6 months from now, they'll just penalize you. They'll likely take all of that, you know, higher rate they were going to give you plus a little bit of a penalty. Um, Risk premium. So, yeah, that's the additional above that risk-free rate. So there's going to be a standard rate, Fed rate. In Europe, they call it the LIBOR, the London Interbank um, Origination Rate or whatever. Anyway, that was the lowest rate, and then everything else went up from there. And so there's a standard rate, and then it goes up. And so when you hear about monetary policy, they're always talking about that base rate. And then the loan rate, obviously, they loan it out at a higher amount. And then if you've got worse credit, you present more risk, then you're going to have to pay even more. So, yeah, if you need the money for something quickly, you probably can't afford to put it in one of those longer term things. And you also, market volatility is a thing, The stock market tends to go up at 10% at least per year, but it has its up years and its down years. If you need money within a year, the stock market is probably not the place to put it because if there happens to be a swing to the downside, even though it's probably going to come up and compensate for it in the future, given your time frame, that's probably not going to work. So now, if you do have money, you don't need it for a while, you should probably take correspondingly more risk, accept more volatility, but there's got to be a relationship. You don't want to needlessly take risk, but if you're compensated for it, then then that's a good thing. So the term structure, rates, maturities, risk-free debts, annualized yields. Anyway, there's a lot of moving parts. You got to look at it. There are treasury securities, and so when they say a treasury security, they're talking about a financial instrument that's backed up by the full faith and credit of the U.S. government, which represents very low risk, as opposed to like commercial paper where it's based upon some corporation or maybe some sort of municipality that, there have been a few municipalities that go bankrupt or just aren't in good financial shape. The federal government, they might, they may have some debt and stuff, but they're not going to go bankrupt because they can print money as needed. So less risk. Not good risk. Would cause inflation to run away, but they're not going to default. Loan rates. So, yep, they make a profit. So I think I've hit this thing a couple times. That's where banks and financial institutions make their money, is the difference between those two. What actually sets the interest rate? Why they change? Well, the business cycle, the private sector and the global money supply, these big macro factors. But then you get people like the Federal Reserve trying to control the money supply and so trying to manipulate interest rates. So they'll buy up currency or they'll sell currency and they'll try and manipulate the money supply to manipulate the interest rates. And by manipulating the interest rates, if interest rates are low, businesses want to borrow and they want to expand. If interest rates are high, it's going to slow things down because now loans are, not as available or they're much more expensive. So they try to regulate the cycles on the business cycle. They try to smooth out those cycles by manipulating the monetary policy. Are they good at it? To a certain extent, but sometimes it gets to be, beyond their control when the global money supply, the business cycle is so far out of whack. Um, all the interest rate actions they take may not cause a change, may not stimulate or restrain the economy like they want to. So the Fed increases the supply of money so they can just print money or they can buy up securities, they can tighten things. So anyway, they try and get the interest rates to go up and down. So firms, more willing to expand when the rates are low. And so people are more interested in borrowing money if they're low. They're going to buy bigger houses because they can afford more because the interest rates are low. And so things improve. Now, all that can work in the other direction. So anyway, the government demand for funds can change all of that. And sometimes you get in a situation where you have the private sector and the public sector competing, and that can have an adverse effect. Um, Especially what you're seeing right now with, if they say, oh, we need to rein in federal spending, and then the GDP drops, the gross domestic product drops. Well, that is going to happen. Spending. Um, at least in terms of the GDP. It's has great differences on the economy. I mean, if it's come from the private sector, then it's kind of found money. If it's coming from the public sector, well, then it's money that needs to come from the taxpayer. So you stimulate the economy, but then you raise taxes and um, suppress the consumers, and anyway, it's a vicious cycle. How does it fit within your financing plan? So again, you're going to assess and use whatever criteria and write this up and kind of decide what is best for you, what you think works. Um, so for me, especially on my liquid deposits on checking accounts, I absolutely don't care what the interest rate is because it's just not going to be that significant. Um, on these other things, on a mortgage, can be, huge changes. Um, Fees for checking services, yeah, sometimes where they have these extraneous services that are Again, they were charging for mobile deposits and things like that. You find more on a national scale. You can't have these because of the competition. You generally see lower fees, or you see compensation. Like, for example, I can use my ATM card at any branch I want because I get reimbursed, whether it's a gas station or whatever. I get, I don't know, 12, $15 back per month because they reimburse whatever fee is paid to an ATM. So I don't even have to find any particular network. I don't care. I just use whatever ATM's close by. So in that way, the online bank is actually more convenient than the local bank. Here's some interest rates that are being paid right now. Now again, I've kind of heard of these banks, and they are FDIC. Are there in order to get 4%? What do I have to do? On all these, they've got basically no minimum balance. But anyway, not necessarily a bad place to park your money for a while, perhaps. But keep in mind, the inflation rate, when they say you're making 4%, that doesn't mean you're necessarily going to profit at 4% because, the interest rates they're down a little bit lower now, but 2022, all these ones you'd be underwater. You'd actually be losing money even making 4% because, when you're in higher inflation times. And this again is this chart where I'm trying to show you that the overall stock market, yeah, there'll be ups and downs, but the overall trend, if you had to draw a straight line, it's going up by at least 10% per year. Managing your money. So looking at more different types of accounts. Um, so this is, I've already sort of talked about this a bit, short-term cash. We're not talking long-term investments other than the fact that if you have too much in short-term cash, you should shovel it into long-term investments. But what's going to be the best way to take care of this? You have a need for liquidity. You've got to pay your utility bills, your car payments, your rent, mortgage, whatever. So maybe not optimized for a big brokerage account that's got, very few transactions coming through it. But again, you may not want just a straight checking account. So maybe some sort of balance there, compromise. You can use credit cards for liquidity, like I'm saying, to cover, car repairs or appliances that fail. It might help you reduce your amount that you have to keep in your emergency fund. But just the same, you still need that emergency fund because if you put, say, 4 grand on your credit card, you want to get that paid off in a month so that you don't have to pay those finance charges. Highest possible return on short-term investments. So again, now we're kind of crossing the streams. We're getting into, for me, I tend to move my money out of the checking account and into a longer term. I'm not so much worried because I'm not keeping that much of those large of amounts where the interest rate is significant. So checking account, obviously, most of us have them. Very liquid, overdraft protection, good thing to have. Again, if you overdraft your account, if you write checks for more than you have in your account, essentially, that's like a criminal act. And so the point is, you're not going to go to jail over it for little things, but you will have to pay whatever fees they have, um, just because you maybe could have prevented that with an overdraft that would have, say, if your account got overdrawn, it just rolled onto your credit card and the people still got paid and none of the fees applied. Stop payments. If you lose a check or something like that, you can go to the bank and put a stop payment. And as long as that check hasn't cleared, when that check is presented to the bank, it won't be honored. Now, if it's a lost check, that's a good thing because if it was presented to the bank, well, then it wasn't lost. Somebody found it. So, but if you have that stop payment in there, if it is lost, but more likely if it's lost, it's never going to be presented to anybody. But so you can get another one from the person who wrote you the check, a fresh check. They're going to want some sort of certainty that that other check, when it does show up, is basically going to be thrown away. Direct deposits, we know how that works. Fees, obviously vary considerably. And most checking accounts don't have, or they maybe they have like a minimum balance required to get the, it's counterproductive. You're better off not keeping that much money in there and getting that extra money you would have kept in there and putting it in a different type of account, preferably a long-term investment. So they have all sorts. I just call them branded money market accounts. They have these things called now accounts and cash management. They'll have different sort of marketing buzzwords, but usually there's some sort of compromise rather than just a regular checking account. They may require a minimum balance, and they may not have the same, convenience of another checking account. So it's kind of a trade-off. Usually, though, I have a money market account associated with my brokerage account. So I've got a checking account with the bank, with the local bank, or whatever bank you've got, and then with the brokerage account, I'll have my cash management account, and that's more of a parking place where if I'm looking at stocks or investments or something, and maybe I want to spend some more time looking before I pull the trigger, or right now to be buying stuff that's at all times high, that's kind of scary. I've got a friend of mine, and I mean, I just want to whatever, but she was telling me how she's probably gonna be buying silver this weekend. Silver's skyrocketing, which is a good thing, but are you buying at the very tippy top? Are you providing somebody else their exit liquidity so they can get out of that investment? I mean, if crypto's pretty stark, I've made a bit of money on crypto, not that well, whatever. I've done all right, but I know where that money's come from. It's come from the other guy. It's a zero sum game. And for every dollar I've made in crypto, somebody else has lost it. So, it's you just got to ask yourself whether you're the guy making the money or you're the guy paying for somebody else's lifestyle. So anyway, um, but yeah, to be buying silver on this weekend, that's a gutsy move. I don't know. It's a bold strategy. I'm not sure I'd try and pull that one off. Um, so savings deposits. Yep. I've never found the utility really in a strictly savings deposit. Like, I've got a checking account. They always ask me if I want a savings account. No, I do my savings in another institution. I'm good with that. And I want that physical, delineation between the two accounts for not only psychology, but also for everything else. If something happens to one of my big accounts and I see some weird transaction, there's not that many transactions there. It's very easy to track down what happened. In a checking account where debits and credits are flying back and forth and ACA, it's kind of a mess. I would not feel comfortable with all those transactions taking place in an account that had, a decent amount of money in it. Certificate of deposit. So we talked a little about this. This is something where you take a higher rate, but you give up some liquidity. You start putting some time restrictions on it. It may have to mature for 5 years or something like that. So it's a bit more of a gamble because now you're having to give up some liquidity. Treasury securities, we talked about things that are guaranteed by the U.S. Treasury, T-bills, different types of things. Again, not going to be as competitive as the stock market because there's no risk. You're not taking any risks, so you're not going to be rewarded. Um, anyway, I'm not talking about taking risk for risk's sake. I'm talking about taking risk because the compensation offered is significant to make it worth it. Money market funds, same sort of thing. They can invest in a variety of items. Commercial paper, so that'd be things owned by corporations, money market funds. and then asset management account. Now we're kind of getting into just semantics and marketing speak. Difference between it depends on the brokerage you're dealing with, who's involved. So this concept of a sweep account, you sell something and they basically go through and they sweep those proceeds and they put them into that centralized account and they're just kind of reset. Now you've got a cash position and next time you want to invest, you draw from that fund to from that account to buy more securities. Um, again, most of these are pretty straightforward. The deal is for liquidity, you've got to give up something. If you want super liquid, well, you're not going to make much money in interest because the bank, can they do much with those funds? They don't know when those funds are coming out. There's no time guarantee. If you're willing to give up um, some of that liquidity or some of that time liquidity, they're maybe going to give you a higher rate. Or if you're willing to put in a bunch more money, maybe they'll give you a higher rate. But it's all conditional. You've got to read the account fine print. And here's how it looks on the chart: the return versus liquidity. But here they get out longer time frames, but they'll give you more money, a higher return. Credit risk. So, yep, the risk of the borrower. So that's essentially the default risk. Um, Interest rate risk that they've taken out a CD and they're going to pay this interest rate for 5 years. They're taking some risk based upon what's going to happen to interest rates over 5 years, and then the liquidity risk, um, convert that money into cash. So different things will affect liquidity, the economic conditions. So um, less reliance on external forms, weak economy, you may be in a situation where you need to borrow more money. Consider the risk return trade-off. Any decision. Um, yep, money market instruments, they're a safe investment. Does not mean they're going to keep up with inflation. They may hold some commercial paper. If you want to avoid that type of risk, then you'd want a treasury bill, but you'd expect to get paid just a little bit less in interest rate. Again, it's all your amount you earn is correlated to your risk exposure. Optimal allocation. So, yep, you want to keep enough money in there to pay your bills, have a budget. We talked about budgeting, and then the remaining funds, get them out of there. Put them in longer term investments. Don't just sit there and stare at them. That big chunk of cash sitting in your checking account is doing you no good. In fact, I'd argue it's at risk. It's a parking place for semi-idle funds. So you get your regular checking account. You might have a money market while you're trying to figure something out, or you've got some expense coming up, say in the next year, and you don't have anything better to do with it. Well, 5% is fine, so you'll take that. But this is what I do: a convenient checking account, local online bank, and another account in a separate institution. You know, the um, big brokerage, low velocity, low number of transactions. The checking account is going to be high velocity, hard to keep track of, but hey, we're not talking huge sums of money, but we are talking a lot of transactions. One option, yep, good companies out there. I deal with Fidelity quite a bit. There's Vanguard, other options. Um, we'll talk more. I'll come back to this term project, then I'll talk about the homework. The homework is just exactly what I was talking about with the banking options. You're just going to write it up. You're not going to find this question spelled out in the book. It's on you. But let me show you some. Well, let me talk about the term project. So the term project is going to be, um, kind of your financial plan. 1 month in the term, so we're coming up on that. You've got a little bit of knowledge so far. Um, Most of you may not be dealing with, you know, big chunks of cash. Maybe you're getting through college and that's your primary thing right now, which is appropriate. But it doesn't make sense to come up with a huge financial plan about, when you're just talking very small sums of money. So kind of a proficiency, advance yourself out forward in your career and say, okay, from this point forward, I'm making whatever, some steady income. And this is kind of how I'm going to conduct my life. I'm going to, allocate 15% or whatever to investments. I'm going to budget like this. I'm going to, invest in my retirement. I have student loans. My strategy to get those paid off is this. I'm going to take advantage of, tax deferred savings. You're going to go through all the different steps and you're going to come up with your plan of how you're going to get ahead in life. You're going to look at, okay, these are the different types of insurance. This is what I'm going to do. So, my point is that when we're looking at some of these big websites, these guys can help you out. I mean, there's a lot of different things. This is Fidelity, one of the ones I was just talking about, but the websites are slick. Um, you know, if you want to, primarily your plan is going to encompass a lot of things about planning, retirement planning, and they've got all the different type of calculators in here. They'll explain all the different terms, and you can kind of cut and paste. Um, you can find a chart in here that you might want to use. Um, use some of their online calculators and things, some of their different tools. Um, put your goals in here. Okay, so now they're going to want me to log into my personal account. But anyway, all kinds of stuff. For most of it, for all these planning type things, or at least the advice type things, you don't actually need a login. You don't need to be a member. In terms of choosing a company, whether it's Fidelity, Vanguard, T. Rowe Price, whoever, um, if you're already employed and your company has got a 401k or you already have a 401k with somebody, whatever company that is, most of these guys are based out of, for the most part, Boston. But anyway, the East Coast kind of firms, and they usually have similar products. And for simplicity's sake, um, unless you have a reason to think otherwise, you might want to go with the company that you already have an established relationship with. But this is where, I would have um, an account. Here's cash management, which we're talking about tonight. Again, they want to take me specifically to my account, but you could set up an account in here. You can do all kinds of different stuff. And again, I'm not shilling for Fidelity directly. Um, Vanguard, you're going to see a lot of similarities, same sort of things. Okay, so they're going to try and tell you why they're different. Um, good luck. They're all going to be quite similar. Maybe one website appeals to you more, but I think really it has to do with, especially this end of the year time where you're getting all these tax forms. If you're associated with 20 different companies, it kind of makes a mess. If you've got one company and they're integrated, um, in addition to your bank, I'm saying maybe a local bank, and then your brokerage type funds over here. Although these guys, if you just wanted um, one financial firm that you're dealing with for your life, I mean, just about all these guys can do it. I mean, they'll get everything you want, ways to save, more topics. Let's go back to Fidelity again. Um, 529 plans, college plans, life insurance. These guys will even sell crypto now, spending and saving, you know. Anyway, um, some good companies out there, and they can't get away with charging the exorbitant fees that other folks do. You can get your card. Now, granted, they're only paying 2%, but Bees only charges 3%. The reason why I get 4% on mine is because it's American Express and they charge, I think, 4% or better. And I have enough money with Coinbase to do it. So they pay me the higher reward. But anyway, there's different options. There's entire websites dedicated to what's the best credit card for you. And I'm not trying to get you to spend money on your credit card if you're going to carry a balance. I'm talking about situations where you only pay off your balance every month. Anyway, okay. I think we've gone on long enough on that stuff. Let's see if there's anything else we need to cover. I think the homework is pretty straightforward. Just what's important to you about your checking account, why you like your bank, why you don't like your bank. If you keep your bank, fair enough. If you change your bank, maybe some goods come from this. But my intent is not for you to, but believe me, there are some practices they do in Alaska that are just would not be tolerated. I took a cashier's check for a large piece of equipment, and I went into a bank, and a bank everybody knows of, and they said, "Yeah, we've got to put a hold on this check for a week." I'm like, what part of cashier's check do you not understand? And they were, serious a heart attack. I went to the bank on the other side of the parking lot. I said, okay, I brought a cashier's check in. When's this money available? They're like, well, sir, you don't understand a cashier's check. It's available right now. I'm like, good answer. And so, I left that bank. Or they also wanted, you know, what was it, $15 a month to use mobile banking. Like, screw you. So anyway, but again, banks change. So you got to keep up with it. All right. Well, that's going to do it for this evening.